UK 30-year gilt yields hit 5.76% on Tuesday, the highest level since 1998. That number alone would be alarming. What makes it extraordinary is that it happened while yields in every other major economy were falling. The divergence points to two simultaneous shocks colliding inside the same market. The first came from the Middle East. The Iran war has pushed Brent crude past $100 and kept it there, sending UK inflation expectations sharply higher. When oil prices rise, the Bank of England faces a choice between letting inflation run or hiking rates to contain it, and either option is bad for long-dated government bonds. The market has already priced in the pain. The 10-year gilt crossed 5.09% the same day, reversing weeks of gradual improvement. The second shock is domestic and political. Thursday's local elections are widely expected to deliver a heavy defeat for Keir Starmer's Labour government. Backbench MPs are reportedly preparing no-confidence letters for the moment results land. A leadership contest from the left of the party, with candidates more comfortable loosening the fiscal rules, is now being priced as a real probability. Mohammed El-Arian, former PIMCO chief, noted the 12 basis point move in 10-year gilts had decoupled entirely from oil prices and from peer economies. That kind of decoupling is a signature of political risk premium, not just macro repricing. The historical reference point is Liz Truss. Investors in the gilt market still use September 2022 as their benchmark for what happens when fiscal credibility cracks. Yields surged, long-dated bonds collapsed, and the Bank of England was forced into emergency bond purchases to prevent a pension fund crisis. That experience means gilt investors do not wait for the fiscal damage to materialize, they front-run it. The question is whether Rachel Reeves has enough fiscal headroom left to absorb another round of pressure. Her March budget had already been trimmed by rising borrowing costs since the autumn. The answer to that question lives in what the banks have already started to report.
The fiscal stress in the gilt market did not stay abstract for long. HSBC reported on Tuesday that first quarter profits fell 4% year-on-year to $9.4 billion. Revenue rose 6%, so the profit drop was entirely driven by provisions, a $400 million fraud-related charge in private credit layered on top of a $300 million reserve specifically set aside to cover losses from the Iran conflict. That layering matters. A private credit exposure was a self-contained failure, one that likely would have happened regardless of geopolitics. But the Iran war provision shows that management expects the conflict to produce further deterioration in the asset base. HSBC's footprint in the Gulf and in global trade finance makes it more directly exposed than most European peers. When the largest bank by market cap on the FTSE 100 takes a targeted war provision in a quarterly report, it is not hedging language. It is a signal that the credit cycle in conflict-adjacent markets has turned. The wider FTSE 100 reacted accordingly. The index opened lower, and the drag was concentrated in the banking sector. Intertek bucked the trend on a takeover bid, but the financials remained underwater through the session. The critical link between this and the gilt sell-off is the Bank of England's position. Governor Andrew Bailey has already flagged that the energy shock represents the toughest mix of challenges the institution has faced in years. The bank held rates at 3.75% at its most recent meeting, but the market is pricing a material probability of hikes through the summer. If the bank moves, mortgage rates, already at their worst affordability level since 2008, absorbing 21.3% of gross household income nationally, will move further against borrowers. The banking sector's provisioning suggests that stress is already arriving at the balance sheet level before a single rate hike has occurred.
The two chains running through today's session converge on the same forward question. Does the UK economy absorb this, or does it tip into the contraction markets are beginning to price? EY's Item Club warned this week that inflation is heading toward 4% by summer, unemployment toward 5.8% by mid-2027, and that the economy could flatline for 6 months, what the forecasters called flirting with recession. The weight of the evidence leans toward further stress rather than quick stabilization. The gilt market is pricing political risk on top of macro risk, and those two do not move together unless investors have lost confidence in the institutional anchor. The Bank of England holding at 3.75% while inflation expectations rise is a position that gets harder to maintain with each passing data point. HSBC's war provision suggests corporate credit is already adjusting. Mortgage affordability at a 2008 equivalent level means consumer demand has limited cushion. These three signals pointing in the same direction at the same time are not coincidence. The recovery scenario exists, and it requires two conditions. First, some resolution in the Middle East. Even a partial ceasefire or a confirmed reopening of the Strait of Hormuz would take pressure off oil and flatten the inflation trajectory. Oil has already fallen from its $126 peak back below 90 in one session when Tehran briefly opened the strait, showing how fast the macro picture can shift on a headline. Second, the local election outcome matters for the pace of the gilt tell-off. A Starmer survival, even a bruised one, removes the immediate leadership uncertainty premium from yields. If 30-year gilt yields stay above 5.76% through the end of this week, that signals the market is no longer treating this as a temporary political shock. If the 10-year holds above 5.09% while the Bank of England is still on hold, the next move from the MPC becomes very difficult to call a cut. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.